How do pivot points strategies perform under various market conditions? Pivot points strategies are adaptable to various market conditions. They can be effectively used in both trending and ranging markets to identify potential turning points or areas where price movements might pause or reverse. Pivot points strategies are adaptable and can be effective in both volatile and stable markets. They provide clear, quantifiable levels which are especially useful in directional markets, helping traders to identify potential turning points or continuation patterns. However, their effectiveness can vary in extremely volatile markets where price movements are less predictable. What risk factors are involved in pivot points strategies? The risk factors in pivot points strategies involve mitigating risks with clear support and resistance levels. While pivot points provide structured levels, the challenge lies in correctly interpreting these levels and responding to false breakouts or unexpected market moves. The risk in using pivot points lies in the possibility of price movements breaking through these levels unexpectedly, leading to potential losses. However, the strategy provides a clear framework for setting stop-loss and take-profit orders, helping traders manage their risk exposure. Understanding how to interpret these levels in the context of prevailing market conditions is key to mitigating risks. What are the potential rewards of employing pivot points strategies? Key potential rewards of employing pivot points strategies come from gaining from accurate level-based trading. By accurately identifying and trading around these pivot levels, traders can capitalize on price movements between these points. The reward potential of pivot points lies in the successful anticipation of price reactions at these key levels. The best case scenario is accurately predicting whether prices will bounce off these levels or break through them, leading to profitable trading opportunities. However, traders should be aware that not every pivot level will result in a significant price reaction, and average returns will depend on market conditions and the accuracy of the pivot point calculations. What considerations should be taken into account when implementing pivot points strategies in futures trading? Key considerations when implementing pivot points strategies include applying pivot points effectively. This involves understanding how to calculate pivot points, integrating them with other technical analysis tools, and recognizing how price reacts at these levels in different market scenarios. Implementing a pivot points strategy effectively involves calculating the pivot point and support/resistance levels based on the previous day's high, low, and closing prices. Monitoring price action around these levels during the trading day to identify potential entry and exit points. Combining pivot point analysis with other technical indicators or chart patterns for a more comprehensive trading approach. Setting stop-loss orders just beyond the identified pivot levels to manage risk. Being aware of market news and economic events that could influence price movements and impact the reliability of pivot levels. Pivot point strategies in futures trading require a systematic approach and an understanding of how prices tend to behave around these key levels. Traders should be prepared to quickly adjust their strategies based on how the market reacts to these points, making it a dynamic and potentially rewarding approach for those who master it. What are some stock option trading strategies? Let's take some time to cover some of the strategies. Using covered call to speculate in stock options. This involves holding a long position in a stock and selling a call option on the same stock. The goal is to generate income from the option premium, especially in a flat or slightly bullish market. What is the primary objective of the covered call strategy in stock options trading? The primary objective of the covered call strategy in stock options trading is generating income through option premiums. By selling call options on stocks that the investor already owns, the strategy aims to earn premium income, supplementing the returns from the underlying stock. The primary goal of the covered call strategy is to generate income through the selling, otherwise known as writing, of call options on a stock that the trader already owns. This strategy is particularly geared towards income generation, leveraging the option premiums received as a source of earnings. It is less about capital appreciation of the underlying stock and more about earning from the options market. How does the covered call strategy perform under different market conditions? The covered call strategy performs optimally in flat or mildly bullish markets. In these conditions, the stock price is less likely to rise above the strike price of the call options, allowing the seller to retain the stock and collect the option premium. In strongly bullish markets, however, the potential for higher stock profits may be limited. Covered calls are most effective in flat or slightly bullish markets. In these conditions, the underlying stock is less likely to experience a significant increase that would lead to the option being exercised. This strategy is less suitable in strongly bullish or highly volatile markets, as the potential for the stock to rise significantly above the strike price increases, which could lead to the call option being exercised. What risk is associated with the covered call strategy? The risk associated with the covered call strategy involves balancing stock ownership and option risks. While the strategy offers premium income, there is a risk of the stock being called away if its price rises above the option's strike price. Additionally, if the stock price falls significantly, the premium income may not offset the capital loss. While selling a covered call limits the downside risk to the extent of the premium received, it does not eliminate the inherent risks of owning the stock. If the stock price falls significantly, the losses may far exceed the income received from the option premium. Additionally, there is an opportunity cost if the stock price rises well above the strike price, as the stock may be called away. What potential rewards can be expected from a covered call? The potential rewards from a covered call include regular income from premiums with limited capital gains. The strategy provides a steady income stream through the collected premiums, but limits the upside potential if the stock price rises significantly beyond the strike price of the call option. The primary reward of a covered call strategy is the income generated from the option premiums. This strategy provides regular income if the options expire worthless, allowing the trader to sell options repeatedly. However, the trade-off is limited capital gains on the stock. If the stock price rises above the strike price, the trader may miss out on these additional gains. What are the key implementation steps for a covered call strategy in stock options trading? Key implementation steps for a covered call strategy include selecting the right stock, choosing an appropriate strike price and expiration date for the call option, and executing the strategy by selling the call option while owning the underlying stock. Monitoring market conditions and managing the position as needed are also important aspects of this strategy. Implementing a covered call strategy involves holding a long position in a stock and having a thorough understanding of its performance and market trends, Choosing the right call option to sell, typically one with a strike price above the current stock price and with an expiration date that aligns with the trader's income goals. Selling the call option and receiving the premium, which is income for the trader. Monitoring the stock and the market to manage the position, especially as the expiration date approaches. Being prepared to sell the stock if it exceeds the strike price or to buy back the option if market conditions change significantly. A covered call strategy in stock options trading requires a balanced approach, considering both the benefits of premium income and the risks associated with the underlying stock. Traders implementing this strategy should have a clear understanding of their income objectives, risk tolerance, and the market dynamics of the stock involved. Let's talk about protective put to speculate in stock options. In this strategy, an investor buys put options for a stock they already own. The put option acts as insurance, protecting against a significant drop in the stock's price. What is the strategic goal of the protective put strategy in stock options? The strategic goal of the protective put strategy in stock options trading is hedging against a decline in stock value. By purchasing put options, investors can protect their stock holdings against potential losses, effectively ensuring the value of their stock position. The primary goal of the protective put strategy is to hedge against potential losses in the value of a stock that an investor already owns. By purchasing put options, the investor gains the right to sell the stock at a predetermined price, thereby providing insurance against a significant drop in the stock's value. This strategy is focused on risk management and capital preservation rather than income generation or speculation. How does the protective put strategy adapt to changing market conditions? The protective put strategy is ideal for uncertain or bearish markets. In these conditions, the risk of a decline in stock value is higher, and the put options serve as a safeguard, offering protection against significant losses in the stock's value. Protective puts are most effective in uncertain or bearish market conditions where there is a risk of a significant decline in stock prices. This strategy is particularly useful for investors who want to retain their stock positions but are concerned about potential short-term downside risks. It may be less necessary in stable or strongly bullish markets where the likelihood of a significant drop in stock value is lower. What is the risk profile for a protective put strategy? The risk profile for a protective put strategy involves limiting downside risk with an added cost. While the strategy provides downside protection, the cost of purchasing the put options, otherwise known as the premium, is a guaranteed expense, reducing the overall profitability of the stock investment. The key risk associated with a protective put strategy is the cost of purchasing the puts, which can reduce the overall return on the stock investment. However, this strategy effectively limits the downside risk, as the put option sets a floor on the potential losses from the stock. The maximum loss is limited to the cost of the put option plus any decrease in the stock value up to the strike price. What are the potential rewards of using a protective put? The potential rewards of using a protective put include protection against losses with limited impact on gains. The strategy allows investors to retain the upside potential of their stock position while capping the downside risk, ensuring that losses do not exceed a certain level. The primary benefit of a protective put is the protection it offers against significant losses, while still allowing for capital appreciation if the stock price increases. The best case scenario is the stock price rises and the put option expires worthless, with the investor benefiting from the stock's appreciation. However, the cost of the put option will reduce the overall profit. What are the considerations for implementing a protective put strategy in stock options trading? Key considerations for implementing a protective put strategy include choosing the right strike price and expiration date for the put options, balancing the cost of the puts against the level of protection desired, and timing the purchase of the puts to optimize cost effectiveness. It's important to align the protective puts with the investor's risk tolerance and market outlook. Implementing a protective put strategy involves owning or purchasing a stock that the investor wishes to protect, identifying the appropriate put option to purchase, typically with a strike price at or below the current stock price, considering the expiration date of the put option, aligning it with the period during which protection is desired, purchasing the put option, paying the premium required, monitoring the stock and the put option, especially as the expiration date approaches or if market conditions change, deciding whether to exercise the put option if the stock price falls below the strike price or to let it expire if the stock price remains stable or increases. A protective put strategy in stock options trading requires a careful balance between the cost of protection and the desired level of risk management.